And now we are mixed. The Nasdaq actually in positive territory, up just 15 points here, but the Dow off its lows of the session, now off just about 260 points. We have Brian Belski, BMO Capital Markets Chief Investment Strategist. Brian, it's great to see you again. We had you on last Fed decision day. Here we are about a month and a half later. What do you think of today's decision?
Oh, Seana, thank you so much for having us. The market really wanted to hear something they didn't know. Tell me something I don't know. And the Fed did exactly the opposite, just said exactly the same thing. In these preambles, the half hour prior to the Fed actually speak is just nothing but conjecture because we don't really know how hawkish he's going to be. Now, our bet is that he continues to be hawkish. And he didn't really like that risk assets have gone up in January, but that's okay. We all know that the Fed's path is beginning to slow. That trend is beginning to change. I think that's what the market is looking at, whether or not it's one more 25 basis point in March or two more March and May. From our vantage point and from the longer term trend, it's a moot point because we actually think that the lows are in place, that we're not going to see an earnings recession. And that the market is already priced in a recession, given what happened, the bad market performance we saw last year. So again, the trend is toward the end of the rising interest rate cycle, and I think that's the key takeaway.
Good to see you, Mr. Belski. You got to play the game for us. Ongoing increases. Tell me what signal you think Jerome Powell is sending by sticking with that language.
Well, I think not unlike everybody else, Briggs, no one can understand this employment situation. It's amazing because the textbooks would tell you that, the market goes down 20%, earnings have to go down 20%, and then we need to see a spike in unemployment. We're not seeing that. And I think it's confounding the Fed. And I think the Fed received so much negative feedback last year that now they're probably overstaying their welcome, quite frankly. But at the end of the day, from our work, from an earnings recession side, we're not seeing it. And I just don't understand how and where the big spike in unemployment is going to come from, which would actually cause the Fed to reverse notion. Maybe we just kind of settle in here, and maybe the Fed just has to live with that being what, quote unquote, would be normalization of employment.
So, Brian, then what does all this mean for equities then this year? You mentioned the fact that earnings recession, it doesn't seem like we are seeing it, at least from the reports that we've gotten so far. So what does that signal just in terms of what's ahead?
It means quality, cash flow. I think it is very, very prudent to remain neutral, meaning market weight technology, because there's a lot of great parts of technology you can, will, and should own. Shouldn't own just a blanket technology ETF, I think. I think you need to own stocks. That's kind of number one. And number two, I think from a contrarian basis, if you're looking for names that the market has hated but maybe have a big theme around it, we love the communication services sector from a thematic perspective in terms of, we call it the 3 C's of communication services: cash, content, and consolidation. I think the streamers are going to consolidate. And when you're looking at matching up a growth and value stock within a portfolio, there's no better sector than communication services. Overall, though, for the first time in over 10 years, we're overweight small mid relative to large because we see a big displacement with respect to valuation, but also earnings growth and discernibility is very strong within the small mid cap space. And then lastly, value, Seana. I think this isn't going to be a binary environment where you have to own either value or growth. I think you can own both. But from a fundamental perspective, you want to look at fundamental value, debt to equity below 1, earnings that are above the market in terms of growth rates, PEs below the market. But you can also own a little GARPy, growth at a reasonable price, as well.
Very casually snuck in some potentially huge news later this year as you talk about consolidation of the streamers. I like that tactic there, Belski. Who could consolidate? Who could be the winner?
Well, listen, I like not unlike all other Americans. I'll get like 10 streaming services. It's too much, right? So the winner, and the one that we've stayed with all along and received a lot of negative press about it, is Netflix. I think Netflix is the Kleenex of streaming. Bottom line, period. Best run, cash flow. Now they're going to advertising. Fantastic. They will be the core, right? I think Disney is going to be part of the core. What happens to Peacock and Paramount Plus and all of these others, I think remains to be seen. And so I think that's kind of where you want to look with respect to potential consolidation, especially given the fact that the content is becoming much more expensive in the streams and how we're going to deliver that content. Netflix has got it right.
So we got what you like a lot. What about what you don't like? What do you say to investors right now, your clients, that they should avoid, at least in the short term?
Oh my gosh, that's a great question. Utilities and consumer staples we just despise. And part of the reason why we despise it is that so many people have rushed into to both those sectors for defense. And consumer staples are one of the most expensive sectors in the market. It had the largest relative increase in multiple, Seana, last year in 2022 in the history of the sector. Whereas you think about debt and bringing on debt and high valuation and long duration assets, well, the highest duration asset from our view with respect to valuation and debt are utilities. And there's always going to be a stock that does not fit that. But from a sector basis, we believe that utilities and consumer staples from a sector basis are the most riskiest assets in the S&P 500.
All right, Brian Belski, pleasure as always, sir. Thanks so much.
Thanks for having us.